Good morning and welcome to the Share Series Monday Management Update. I'm Cristina Fernandez, Senior Analyst at Telsey Advisory Group, covering the home furnishing sector. And with me today is Clarence Smith, CEO of Havertys since 2003. The format of today is a fireside chat. If you have any questions, you can submit them through the question button on the screen, and I will ask them for you. Clarence is going to start with some brief prepared remarks, and then we'll proceed with the fireside chat. So I'll pass it on to you, Clarence.
Thank you, Christina. Good morning. Havertys is a chain of 120 stores located in 16 states from Virginia to Texas. We focus on the higher end customer, upper middle customer. We do more design today, and it's helped us with our average ticket and growing our business. So we're targeting a better customer, more customization, more special order. We've had terrific performance over the last 8 quarters, and we're excited about our potential. So we're pleased to be able to meet with you today.
Thank you, and that's a good overview. I wanted to start with the state of the consumer and the demand. What did you see in the third quarter, and where do you think the consumer is today as it relates to home furnishing purchases?
Well, our incoming orders are softer than they were last year, which was a record year. They're down in the high single digits as far as our incoming orders. Our delivered business is stronger because we're delivering a backlog, and we're expecting to see a softening, but not as much as we have seen at certain times in this past year. So we're tied to housing. Housing is softer, as you know, but we like where we're located. We're located in what we think are some of the best markets in the country. Our biggest states are Florida, Texas, the Carolinas, and Georgia. So that's where people are moving. And I think as we dealt with a higher end customer, they're less affected by inflation and the impacts that the more promotional side are. So we feel good about where we are now. We are delivering our backlog. It is coming down, and we're trying to make sure that we have the incoming orders to support a growth going forward. There's questions about next year just because of that softening.
In talking about the housing market, when you look at the markets you operate in, what are the key metrics that you are looking as far as like indicators of where the business could go or the health of those states?
Well, because we're in these growth markets, the leading indicator historically for us is new home sales in the South. We also pay attention to existing home sales, which used to be a better indicator, but I think new home sales is a stronger indicator historically, and that's been down, as you know, but the housing prices are holding up. So we're not seeing a move away from people wanting to be in the homes. We definitely think we've got to navigate through that, but we're seeing okay business, certainly in our best markets, and that would be Florida, Texas, Atlanta, and the Carolinas. So we have a pretty good balance across our regions. We haven't seen any deterioration, unusual deterioration in any particular region, but we know that the growth areas are what's been driving our business and the average ticket increase.
Yeah, I mean, I think it also helps that there's been some movement into those markets from, people moving from the Northeast and other states to Florida, and jobs are holding up, right, relatively well.
The interesting thing about people moving from the Northeast to Florida, and we've been doing that. We know a lot about that. We know a lot about the snowbirds coming from Canada, but people moving from the Northeast or most anywhere to Florida want new furniture. They do not bring their cherry bedroom and dining room down. And so any movement into these regions where we are generates a lot of furniture purchases. And so we like where we are. We're going to continue to grow in Florida. We've got over 30 stores there, and it is a strength of us. So the same thing in Texas. People moving from California to Austin or to Dallas generally aren't bringing their furniture. They're going to buy new furniture. Any movement creates new furniture sales.
Good. Yeah, another topic I wanted to talk about, just in light of, you know, the entire retail market, there's more promotions, there's more inventory. Can you speak about your business and the furniture business? How are inventory levels, you know, across the space, and are you seeing an uptick on promotions, and are you being more promotional?
Well, I'll start with promotion and then I'll get to inventory. We're primarily more promotional with credit. In the current situation, credit promotions mean more than they did last year. We were not very aggressive in credit promotions last year. We've moved back to our normal pace. And the most aggressive one is 60 months free interest, which is now just starting with us and will run through the Thanksgiving event. So that is more important. It does cost us something, and we pay a discount on the front end. But that's primarily the promotional area that we go. We're not big discounters. We don't believe in that, don't feel like we need to do that. And most of our customers looking for a big purchase, which our average sale is over $3,100. And if we didn't get in the home, it's over $6,000. They will use credit, and it becomes more important at these times of year. Now, inventories. Our inventory position is as strong as it's been in a long time, and we don't feel that we're over inventory. We're handling it well. We didn't go outside of our lineup when most of the industry, in scrambling a year ago to get whatever they could, would buy whatever product was available. We stayed very disciplined with our best sellers. We didn't focus on new product. We focused on filling our back orders. And right now we're in the best position we've been in a long time, being able to serve deliveries. So there's not a delay like there has been for well over a year. And yet we are able to balance the inventories, handling it. And I think by the end of the year, early next quarter, we will be in good shape with not over inventory in any significant category, yet being able to fill orders more quickly.
Shifting to supply chain, it's been a big topic, through the pandemic. It seems like it's gotten a little bit better, but can you talk about how the supply chain challenges have impacted Havertys, and where do you stand today?
Well, supply chain was a major problem over the last year and a half. It's now correcting itself. We're getting shipments quick enough now, particularly domestically. There are some delays getting product through the channels and with flowing it through the freight lines, getting it to the distribution system. But it's much better than it was. It's really very close to pre-COVID. And the other thing that's happened because of that is the freight rates are coming down dramatically, and even well below what our contract rates are. We're seeing more better conditions, better freight rates, better flow of product. And I think by the first quarter, most of that's going to be stabilized to what I would say is pre-COVID. I will tell you that placing orders with the factories today, they're begging for orders. It's feast or famine, and now they're begging for orders. I've heard that for Chinese New Year, which would have been a week or two, now most factories are going to close for a month because they're concerned about orders. Now, that will impact us probably into the second quarter, based on sometimes not being in stock on our best sellers if they close for those periods of time. So it's a flow. It's an ever-changing flow of product. It's more similar to what it was pre-COVID now.
Related to supply chain, can you talk about the inflation side? What have you seen from the product costs or freight costs increases and how that has translated to, higher pricing, or how have you been able to offset the inflation
Well,
portion?
we had two things. The price of the product was going up, and then price of the freight went dramatically up. When we started pre-COVID, a container coming from Asia was $3,500 about, and it got up to mid 20,000. It was crazy increases. Now it's come back into the low, let's say 8,500, that range, and even coming down from that. So the costs there impacted everything. Now, we were proactive in increasing our retail prices. We were able to do that. If we knew it was going to happen, we increased our prices. We were able to hold our margins, and in many cases, increase our margins through that. What we're seeing today I just mentioned the freight declines in pricing, but our manufacturers are coming back and reducing their prices. We've had several companies reduce prices 10% across the board on orders coming in late this year and into next year. So we'll see those price increases as the demand slows down, and we're able to take advantage of it. We know that we're not in trouble with our inventories, and we can buy our best sellers and hopefully get some better values for our customers, not only late this year, but into the first quarter of next year. So we're seeing prices come down in most every area right now. Now, does it make up for the increases on the other side? In some cases it does. In some cases, they're still charging us a little more than they did, let's say, a year ago. So there's constant movement in this pricing.
Yeah. That's interesting. And that's a good segue into talking about profitability. So profitability for Havertys in most home furnishings companies has been, taking a pretty big positive step the past couple of years with the volumes going up. So I guess, how are you seeing your ability to hold, double-digit operating margin, as we move forward?
Well, we have been double-digit. It is an objective. We believe we can do it. We're committed to holding our gross margins and having some opportunity to increase them. It is an absolute priority of our company to deliver double-digit pre-tax profits, and I think we've got the ability to do that. It is a focus of the company. If business falls off, we're able to adjust our expenses. We did adjust pre-COVID where we were. We're down about 20% in our staffing from where we were pre-COVID, and expect to hold that. And if our business falls off any, we will adjust down. We start with our delivery and warehouse, but we've also adjusted. Certainly, if you go back to pre-COVID, we adjusted our staffing here in the home office and in our stores. We reduced our store hours, and don't expect to plan to increase those hours back to where they were. So we're very aware of our expense levels and controlling those and making sure that we get the margins on the product we sell. We're bringing a lot of new product, which we're very excited about, and that gives us the opportunity to bring it in at margins that can help us achieve those double-digit operating profits.
It seems like you've done a lot, and some of it is, structural for your, for the business and the cost structure, particularly the staff reductions that you made versus a couple of years ago. I wanted to see if you could talk about how the company did during the last housing downturn, and perhaps, what is different the way you see it today versus, you were the CEO back then, so sort of how the company was positioned in the housing market then different from what you're seeing now.
Well, I think that the previous, if you go back to the Great Recession, it was a credit crash. The housing market got crazy. That never happened this time. And we're appealing to a better customer. We're not as promotional as we were then. Our average sale was probably half of what it is today. And we weren't doing the design business that we are doing today, which is about 25% of our business. Our customization is around that same range, about in the high 20s. And we're dealing with a better customer, a better product, more specialization. And I think that the markets that we're in are in better shape. So if you go all the way back and let's say 2006, 5 and 6, our staffing at the time was about 4,500 people. We're now about 2,800 people doing $1 billion. So we've got better salespeople on the floor. They're making more money, but there are fewer of them, and able to take care of our customers. We're just leveraging our systems better and appealing to a customer who's probably going to be less affected by a downturn than we did before. We were more promotional. We were competing with the lower end of the market that we don't today. We're targeting now a customer that is Ethan Allen, Pottery Barn, Crate and Barrel, Restoration Hardware even. And I think we offer a better value, a better service, and are able to deliver better than many of those houses.
Yeah, definitely a different setup. You spoke about a couple of the initiatives, so I wanted to see if we could discuss in more detail the company specific strategies you have, starting perhaps with the interior designers, which has been a big priority for the company over the past couple of years. Where is it today, how it has helped you, and where do you see it going?
With design?
Yeah.
Yeah. We are now pushing more than we ever have to let all of our customers know we offer design service, and it's free. We will get in the customer's home. We have a team that will do that in a customer's home. We do measures. So it's something that we're pushing very hard, and our new marketing is trying to make sure customers understand we offer a service that most of our competition does not. And we're good at it. So that end of our business is the driver. I mentioned that we're over $6,000 if we get in the home. We have $50,000 sales. We have $100,000 sales. And these are areas and things we never did before. We now have a system where we can provide the accessorization, the customization, all of that at one time, and flow it through our system and help the customer make the vision of their home come true. And we're rolling out finally, Christina, our new website, which will be in the next several weeks. And that's going to allow more customization online. People will understand a lot of what we're going to be able to do, more specialization, much easier to use, and allow not only our customers to understand it, but for our salespeople to interact with them on the website and make this vision come true easier. So we think there's a great opportunity there. It's only about mid-single digits of our sales now online. We have a target we think we can get to double digits. And not only that, but help our stores close more sales, build more relationships, and help the customer with all of their design opportunities. That's been something that's much bigger than we expected, but it's complete rework of our entire system, utilizing the Adobe platform and then the best of what we have on our end of the system.
Yeah. When the new website goes live in a few weeks, what what is the customer going to see differently, and also like then from the employees and your end, like, is it going to change the customer data you have, or different tools internally to be able to, market or segment the customer differently?
We will have a lot better data about our customer and what she wants. We will be able to feed back to her interest. These are things that you've shown interest in. We can feed back to her that. We're able to move to the top of the website for particular individual customers, areas that they're interested in, rather than just the generic for the front end of the system, and trace all of that and then get that information back to us. It's going to look better. It'll be more inspirational, and send back to the customer things that she's interested in a format that will be more appealing to that particular customer. So it's a major step. And I've seen the graphics. I mean, it's going to look a lot better. It'll allow our marketing people to adjust it much quicker, much more frequently to whatever the customer wants. We'll be able to do A/B testing. In other words, which one more people go to, and then feed it back to them that way. So all of the best of what websites offer. We have a mission to be the best home furnishings website out there. And I think we will have that. And it'll always keep evolving, but I think that's our objective. That's what we're heading to.
Oh, that's great to hear. How about retail stores? You've given an annual store target of opening 5 stores a year starting next year, which is, a big change from the past couple of years. How committed are you to that goal, and what store opportunities are you targeting, and what are you seeing in the market?
It is still our goal. We have not delivered on that. It is an absolute priority that we think we're going to have really good opportunities for retail boxes in our markets. We're good at converting existing boxes over to Havertys. We're opening 2 of them this weekend that we're excited about. One of them's in Indianapolis, is a relocation, and then the other is a new store outside of DC that we've been working on for a long time. We have had some issues in getting projects finished, and some of that was supply chain, not only our supply chain, but just in getting construction product finished and stores done. But we think they're going to be very good opportunities for us in existing markets where we add one store to a second store to a market that can support it. And also any stores within the reach of our distribution footprint. And there are probably several other states that we could reach from our distribution footprint that we're targeting. And we think that there are good opportunities of at least 5 stores a year for the next several years. And I think there'll be more as other retailers are struggling. And we've also targeted boxes that are smaller than our standard footprint. Our standard footprint has evolved to about 35,000 square feet. We've done very well in stores in the 25 to 28,000 square feet. And we think there are more opportunities, and will be in the years ahead, to fill in for those markets.
What's the state of your current fleet? Do you need to remodel or renovate stores, or are they in good shape? What's been your refreshes over the last, let's say, 5 to 10 years?
I think our store fleet is in the best position it's ever been. We've invested over $100 million in remodeling and repositioning our stores. They look terrific. We're always remodeling in some ways. We'll have a handful of remodeling projects that we have next year. We want to have the best looking store in the market, and I think most cases we have that. So I don't see a major investment in remodeling on our stores right now. And I think we've done that and feel very good about it. On the distribution end, we've also expanded our distribution, our main buildings in Dallas and Florida over the last several years. We do want to expand our Virginia, DC. We've held off on that based on the pricing, but that's something that we will tackle in the next couple of years, if not next year. So we don't have a lot that we have to do for our existing fleet and our existing distribution other than what I just outlined.
Great. We have about 5 minutes left, so I wanted to touch on capital deployment, which has been, a priority. You just announced a special dividend of $1 per share on Friday. So can you talk about, how you and the board think about dividend versus share repurchases and the decision to pay this, to pay the special dividend also this year?
We've been pretty aggressive about returning capital to our shareholders. If you look at the last several years, we delivered a couple of years ago a $90 million. This year, it's going to be somewhere in the high $60 million. And it's been a balance. So we believe in a balance of dividends and stock buybacks. We've got an authority to buy stock back now. We have been in the market all year, and it's something that we believe is the right method. Now, we look at it at the end of the year to see, do we do anything different? And that's why last week we issued authorized a $1 dividend, an extra dividend. But our regular dividend is delivering somewhere 3.5% to 4%, and we believe in that. So it's a mix, and we like to look at stock buybacks more opportunistically, and I think we've done that. We've been aggressive, but not overly aggressive, and we'll continue to look at that. The board looks at it every quarter, and we've increased our dividend over the last several years, every year, and I would think that's something that we would like to continue to do.
And going forward, you ended the quarter with $135 million in cash plus some restricted cash. What are the areas of investment, and how much do you need to spend a year in the projects that you have lined up?
Our CapEx has been around $30 million a year, and that's something we'll see. That's what we're planning, basically, around $30 million a year in CapEx. And we don't think that leverage in our industry is a good thing. We don't expect to get back in debt, don't want to get back in debt, and we want to keep a safety balance, and we will continue to do that. Richard Hare, our CFO, and I believe pretty strongly in that, as well does the board. We know that we're a cyclical industry. We think that we're better protected than much of the industry because of the fact that we're dealing with a better customer in the best parts of the country. And we don't want to put ourselves in a position to have to borrow money at the wrong time. We did increase our revolver. We just closed on a new revolver and went to $80 million. So we're very well positioned to do whatever is necessary to continue to grow our business. We strongly believe that.
Yeah. So we have 2 more minutes to one last question. As you look to 2023, the holiday season, I guess, what are you most excited about as far as, what the company's doing and the initiatives, and what's your biggest concern?
Well, I'm most excited about 2 things. One is the new product that we got coming in. We have not had new product come in our stores for almost 2 years. It's now hitting our stores. We're very excited about it. Our best sellers move to our new product moves to the best sellers right away. And we feel very good about that. the fact that we're in better inventory position than we've been in over a year and a half. And also what I mentioned about our website. I think that's going to change the way people think about us and how we appeal to that customer. We know the website's our front door, and we think that we will have a website that better explains who we are and helps our customer and helps us help her bring her vision of her home to life. So new product, new website, better positioning in our markets, and now we want to grow in our regions with some new locations.
And any concerns for next year?
Yeah, I mean, the macro is the issue. I mean, housing is our key indicator. Housing's not great. Interest rates is what drives that. So I'm hoping that inflation will come down, interest rates come down, mortgages come down, and housing comes back to life. That's what will bring new life to the whole industry and be the main driver of our business.
Thank you. So I think that concludes, we're out of time. That concludes our presentation portion for today's event. Thank you everyone for hosting us this morning. Thank you, Clarence, for your time. Up next is White River Energy. Everyone have a good day.
Thank you, Christina. I
You're
appreciate it.
welcome.